Hello everyone and welcome to the fifth lesson of this workshop. I promised to show you how to trade commodities with lower risk and lower capital. Therefore, we will talk about commodity spreads. But once again, I have to remind you this video is not investment advice. If any financial instruments like futures, spreads, ETFs, options or others are mentioned anywhere in this video, it's always just for educational purposes. Let's start with an explanation of what commodity spread is. We are going to do it step by step so that at the end of this lesson you will perfectly understand everything. We already know what a commodity is, and the spread is nothing more than a difference between the prices of two different futures contracts. To be completely honest, there are also spreads between 3 or 4 contracts called multi-leg spreads. But these multi-leg strategies are somewhat marginal compared to spreads made out of 2 contracts, and we will not talk about them in this workshop. There are 3 types of commodity spreads. The first ones are interdelivery spreads, also known as calendar or intramarket spreads. Interdelivery spread is a price difference between contracts within a single commodity but with different expiration. For example, a spread between July corn and March corn. The second type is called intermarket spread. It is a price difference between contracts from 2 different commodities like July corn and July wheat. The third type is called inter-exchange spread. It is a price difference between contracts for similar commodities but on different exchanges. A typical example is a spread between wheat that trades on the Chicago Board of Trade and wheat on the Kansas City Board of Trade. Technically, inter-exchange spreads fall under intermarket spreads, but this is how the taxonomy evolved. In this workshop, we will talk about the first type, the interdelivery spreads. Why focus just on interdelivery spreads? Well, it's because they are viable for most traders, especially retail traders. As we promised, they will allow us to trade commodities with a smaller capital. And intermarket and inter-exchange spreads are much riskier and require a really large account. Let's show a few interdelivery spreads on this term structure of lean hogs. This chart is particularly useful for this purpose as it shows the prices of all the futures contracts for a single commodity. As we explained in the previous lesson, these dots represent individual futures contracts. The more to the right the dot is, the farther the expiration date. The vertical axis denotes price. The spread is simply the vertical distance between 2 contracts. For example, this green arrow represents one such spread. The second arrow is another example. Or this tighter spread between 2 distinct contracts, so we can assemble a great number of various commodity spreads. Moreover, we do not have to choose a spread between 2 neighboring contracts. In fact, we can select any combination of 2 different futures contracts. There are really many combinations between all the contracts. However, not all of these combinations make sense from a trading perspective. But you will understand it after finishing this workshop. There is one more important thing in this chart. As you remember, we said that term structure shows future market expectations, but these expectations are changing every day. That means the prices of these contracts are changing. So the spreads are not constant over time. These green arrows we draw are becoming shorter or taller every second the market is open for trading. And that is exactly the reason why we can make money on commodity spreads. Given the right spread and good strategy, we can profit, for example, from this arrow becoming shorter or taller. But why do spreads even exist? We know that the term structure is an expected distribution of supply and demand over time. Without contango or backwardation, the term structure would be just flat. The spreads would not exist at all. But as you can see yourself, contango and backwardation do exist, and therefore spreads exist. And because the term structure is not static, we can make money on interdelivery spreads as they are changing too. Let's show a concrete example of an interdelivery spread. We have corn here. Its symbol is ZC. Then we pick two expiration months, July and March, both of them in 2019. These two contracts are called legs of the spread. Now let's put a spread together. It is July minus March. As we said, a spread is a difference. So let's just subtract the price of the March contract from the price of the July contract. And here is the chart of the spread we just put together. This is a simple price chart showing how the price of the spread moved over time. Here is the proof that spreads do exist as it is not zero. It also confirms that spreads change over time, as the blue curve is not a horizontal line. The curve moves up and down all the time. We will take a closer look at the calculation of the spread price. For example, the July contract had two prices of 442.25 cents and the March 434.25 cents. As we said, the spread is just a difference between these two prices. So 442.25 cents minus 434.25 equals 8 cents. Here is the day on which we performed the calculation on the chart. 1 month later, the price was 13 cents, so the spread became much wider. Let's reverse the spread just for fun. We will use the same contract and only switch their position. By subtracting the July contract from March, we create an inverse spread. What is the price on the same day from the previous example? Well, it's minus 8 cents. Here is the chart of the inverted spread. It's a mirror-like image of the original one. Here is the proof when we stack those two charts on top of each other. What's the conclusion? First of all, it doesn't matter how you assemble the spread. We want the curve on the chart to rise if we hypothetically hold the spread. We make money if it goes up and lose if it falls. Second, don't get baffled by the negative values. It seems unnatural to buy something with a negative price, but it's simply the consequence of buying a cheaper contract and selling a more expensive one. Don't worry if it is not clear yet. That was just a quick introduction. We will get back to spread assembly later in this lesson and explain it in detail. But first, we must go through the basics. How is it even possible to trade a price difference? We will start with a simple outright futures trade example. Imagine that we expect the price of some commodity to rise. So we open a long position. You should be already familiar with the long positions from the previous lesson. And so assuming our prediction was right, the value of the contract goes up by $1,000. That's our profit. But what if our prediction turns out to be wrong and the value of the contract falls by $1,000? Well, we would incur a loss. I think this should be clear. And now replay the exact same situation as spread trader. We expect the commodity price to increase, so we buy a futures contract. But the point of spread trading is that we open a short position against our long position. If our prediction is correct and the price goes up, we make $1,000 on the long position. However, we lose $800 on the short position. When the commodity price goes up, all the futures contracts usually move up too. The whole term structure shifts higher, but as the green arrow suggests, the magnitude of the move is not the same for every contract. The closer contracts usually rise more than the distant ones. That is why this first arrow is taller than the second one. As we explained before, new contracts are more sensitive to changing market conditions. Our total profit is $200. Maybe you think that was not so smart, as we could get $1,000 if we open just an outright long position. Well, it will become clear once we outline the adverse scenario. Suppose that we were wrong. We expected the price to rise, but it has fallen instead. As the closer contracts react more, the left red arrow is larger than the right one. Because we were long, we incurred a $1,000 loss on the near contract. However, we made $800 on the more distant contract as we shorted it, and the price went down. Overall, our total loss is just $200. That's much more manageable than the $1,000 we would lose if we had opened an outright long position. This is why spread trading allows us to trade commodities with lower risk. The second contract acts as a form of hedging. Of course, it reduces our profit too. There is no free lunch. But the lower risk is actually a great thing. Unlike with outright futures, you do not need a huge account to trade interdelivery spreads. Here's an example from real markets. The top subchart shows futures contract on soybeans, while the bottom subchart is an interdelivery spread on the same commodity over the same period. We use the profit and loss calculator in the Spreadcharts app to calculate the hypothetical profit we can reach on both the outright futures contract and the spread. The profit on the spread is smaller, and so is the risk. A much smaller account would suffice to trade the spread. Let's summarize the basics of spread trading. A spread is made out of two positions. Of course, there are also multi-leg spreads of 3 or 4 contracts, but they are not as common. Those two positions run against each other as we always buy one contract and sell another simultaneously. We speculate on changes in the price difference between those contracts. In other words, we do not care about the prices of individual contracts. Before we move on, I have to describe how the spreads are specified in broker platforms, analytical apps like Spreadcharts, or just for our own purposes. We identify individual futures contracts using a ticker made out of commodity symbol, expiration month, and year. All we have to do is connect two tickers in a certain way to denote an interdelivery spread. There are two different ways to do that. The first one is called calendar notation. As its name implies, it is based on the expiration date of the legs of the spread. I try to express it using the formula here. We always write the closer expiration first and the more distant expiration second. The near expiration doesn't have to be the front contract, which is the first expiration contract. I just use it to stress the difference between the legs. The hyphen here does not have any meaning. It is just used to separate these two contracts. Sometimes a forward slash is used instead. So once again, the contracts are ordered by their time to expiration in this notation. Now, how do we know which contract to buy and which one to sell? Well, this is determined by the buy or sell prefix. If it is a buy, it is assumed we buy the closer contract and sell the more distant one. If it is a sell, we sell the closer contract and buy the distant one. In this case, the spread is called a reverse calendar when we use this notation. And now, I will show you the second way to specify spreads, which we call an arithmetic notation. We just write down the tickers of all contracts in whatever order and mark the contract we buy with a plus sign and the contract we sell with a minus sign. That's all. Here is the summary of what I just said. Contracts in calendar notation are ordered by their expiration, and we must specify if we buy a spread or sell it. If we buy it, it is called a calendar spread. On the other hand, it is called a reverse calendar spread if it has a sell prefix. In arithmetic notation, we just identify the contract we buy or sell with either a plus or minus sign. This is exactly the case where an example is better than a long description. So let's make one. Assume we have this spread. We want to go long the July 2023 contract and short the December 2023 contract on corn. In other words, we would buy the July contract and sell the December contract. Let's start with the calendar notation. We will write down the tickers. The July contract is first as it expires sooner than the December contract. And the prefix will be buy, as we will be buying the closer contract and selling the distant one. And now the arithmetic notation. We write down the tickers and prefix the July contract with a plus sign, as we will be buying it, and the December contract with a minus sign, as we will be selling this contract short. You might have noticed two things. First, it doesn't matter which contract is first and which one second. I included both of these options. The minus and plus signs determine what we buy and what we sell. To be honest, people usually prefer the first option where the long contract is first, but it's a matter of preference. Second, we omit the plus sign if the long contract is written first. It is just convenient and it works the same in elementary arithmetics. You would not write plus 5 minus 2 equals 3. It is common to write just 5 minus 3. And it's the same here. But let's move to the second example. In fact, these are the same contracts, but the spread is inverse, as we will buy the more distant December contract and sell the closer July contract. With the calendar notation, we will write down the ticker in exactly the same way as with the inverse spread. July goes first, December second. But this time we have to change the prefix to sell, as we would be buying the more distant contract and selling the closer one. With the arithmetic notation, we just assign the correct plus and minus sign to both contracts. That's all. I can now disclose that we will always use the arithmetic notation. The spread charts app also work only with it. Why is it better? Well, it's simple. I'm sure you noticed it took me much longer to explain the calendar notation than the arithmetic notation. In fact, I used just one sentence to describe the arithmetic notation. Simplicity always rules. We do not have to bother with the buy or sell prefix. It's all clear immediately from the sign before contracts. Additionally, the position of contracts in the expression does not matter, so we don't have to think about it. Another strong argument is that the arithmetic notation represents the exact way the spread is calculated. It's intuitive. And finally, the arithmetic notation is scalable beyond interdelivery spreads. It means we can use it to denote intermarket spreads or complicated multi-leg spreads like the crack or crush spread. On the other hand, the calendar notation is limited to interdelivery spreads only. Now, you might ask why we lost time with the calendar notation when we will not be using it. Although you won't encounter it in the Spreadcharts app, some other software or broker platforms still use it. Thanks to this workshop, you will not be confused by it. To simplify things, let's agree we will always write the long contract first. It is not necessary. Even the Spreadcharts app will chart the correct spread, no matter how you order the contract in the expression. All you need is to have the sign correct. Nevertheless, it is better for us, humans, to write the long contract first. We simply buy the first contract and sell the second contract with a minus sign prefix. That way, it decreases the chance we accidentally enter a wrong spread in the trading platform. And you would be surprised how common these mistakes or misclicks are in trading. Here is an example of what it can look like. When we have this spread, we buy the July contract and sell the December contract. If we want to get an inverse spread, we just flip the position of the legs and the December contract is now first. It's that simple. There is one practical thing I must clarify. Opening positions on two contracts may sound complicated. The price of the second contract might slip away as we are opening the first leg of the spread. Don't worry, there is a perfect solution. All good brokers support the so-called combo order that allows you to open a spread trade at once. We don't have to open the legs of the spread sequentially. The broker would open them both simultaneously. We assemble desired spreads from individual futures contract and then buy the whole spread using the combo order. If we want to close the position later, just sell the spread using the combo order again. You will find detailed instruction in the manual for your broker's trading platform. While some brokers allows us to execute nearly anything through the combo order, we would not get guaranteed fill for every spread. The guaranteed fill means assurance that the spread would open at once at a specified or better price using the limit order. Non-guaranteed fill can result in a partially open spread, which means just one leg of the spread. That's far from desired, of course. What must the spread satisfy to be eligible for guaranteed filling? It must be recognized by the exchange. The good news is that the exchange recognizes all interdelivery spreads, and the combo order should have guaranteed filling for these spreads. Even a few popular intermarket spreads are recognized, but definitely not all of them. So be careful trading these intermarket spreads. Maybe this was a bit too technical. You don't have to know it all, as you will find detailed info regarding combo orders in documentation to the trading platform provided by your broker. Just remember that you can open the spread at once. Spread trading is therefore no different from trading other common assets like stocks or outright futures in a practical sense. And we are finally getting to assembling a spread. We briefly mentioned it theoretically before, but we haven't yet explained it in practical terms. There are two distinct interdelivery spread strategies: bull spread and bear spread. Let's start with bull spread. When something is bullish, it is strong, like bull. When some market is in a strong uptrend, we tend to call it a bull market. Therefore, it is no surprise that bull spread usually profits when the price of the underlying commodity is rising. Of course, usually does not mean always. This relationship might disconnect in some special situations or when the underlying trend is weak. But generally speaking, the bull spread correlates positively with the underlying commodity. A bull spread is assembled by buying the closer contract and selling the more distant one. We will present a practical example just in a moment. A bear spread is exactly the opposite to bull spread. When some market is in a strong downtrend, it is called a bear market. Bear spread, therefore, profits when the underlying commodity is trending down. We assemble a bear spread by selling short the closer contract and buying the more distant one. And here is a practical example using the same structure chart. We will start with bull spread. You should already know that the closer contracts are more sensitive to the movement of the underlying commodity than the distant contracts. So if we expect the price of the commodity to rise, we buy the closer contract and sell the more distant one. That's our bull spread. Now bear spread. Once again, if the underlying commodity is trending down, the closer contracts will fall faster than the distant ones. We sell the closer contract to capture this move and hedge our position by buying the more distant contract. We just created a bear spread. Okay, it is wise to hold a bull spread when the commodity price goes up and a bear spread when the commodity is falling. In reality, these spread strategies allow us to capture additional profits thanks to the so-called contango effect. It is negligible in the short term but can be decisive in the long term. I will explain it shortly as I don't want to spoil the lesson with too much theory. In one of the previous lessons, we explained the seasonality effect where the risk premium dissolves, which pulls the price in some direction, usually down. This effect is even stronger with interdelivery spreads. That's because we filter out the directional movement of the underlying commodity to a certain degree with spreads. The markets are mostly in contango, as we told you before. If nothing is happening in the markets and the supply and demand stay hypothetically constant, the prices of contracts would still drift lower. That's because the time to expiration is shortening and the inherent storage costs are becoming smaller too. But this affects all the contracts in the same way. However, the prices of closer contracts would drift lower slightly faster than the prices of more distant contracts. This is due to the dissolving risk premium. This effect is not linear. The premium simply disintegrates faster as the contract approaches expiration. The result is that closer contracts are falling slightly faster than the more distant ones, and bear spreads can capture this contango effect. As I said, this effect is rather weak and is overpowered by the directional moves of the underlying commodity in the short term. But its significance becomes apparent in the long term and can provide a meaningful statistical edge. When the market is in backwardation, the storage costs are not factored into the futures prices. But the risk premium effect is still present. It just acts in the opposite direction, pushing the closer contracts to drift higher faster than the distant contracts. Therefore, bull spreads can capture this effect when the market is in backwardation, but it's fair to say the market tend to be pretty wild when they are in backwardation with directional moves dominating. Enough theory. Let's summarize the practical consequences for the bull and bear spread strategies. Besides the rising price of the underlying commodity, bull spreads perform the best when the market is in backwardation. That's the state when closer contracts are more expensive than the more distant ones. The term structure curve is downward sloping. Of course, we have to take the crops or seasons into account in physical commodities. That doesn't mean bull spreads can profit when the market is in contango. You bet it can. But think about it in statistical terms. The potential reward compared to undertaken risk is simply better for bull spreads if the market is in backwardation. It is exactly the opposite for bear spreads. We said that they usually profit when the commodity price is trending down. Additionally, this strategy is best deployed when the market is in contango. That's the state when the term structure curve is upward sloping. And we are approaching the end of this lesson, so let's summarize the advantages of interdelivery spreads. They allow us to trade commodities with much lower risk compared to outright futures. The margin blocked by the broker is also significantly lower for interdelivery spreads. All of this means a smaller account is required to trade spreads. Another advantage of these spreads is that they filter out external effects to a certain degree. What are such effects? The macro influence, currency movement, and other externalities. Generally, factors not directly associated with the underlying commodity. The spreads better reflect the true supply-demand situation on the physical market. For example, if there is a panic on the stock market and fear is spilling over the commodities, spreads would largely filter out this effect. On the other hand, if there is a real supply or demand issue with a commodity, spreads can move even faster on a relative basis than the underlying commodity. Every coin has two sides. As we explained, interdelivery spreads benefit from the seasonal trend more than the underlying commodities, and that's great. Finally, we can utilize more advanced money management because interdelivery spreads are cheaper and we can enter or exit positions gradually. Spread trading is not time-consuming and perfectly combines with other trading styles. These strategies tend not to correlate much with the broad market, resulting in better risk-adjusted returns for your entire portfolio. And that's all for now. I'm really looking forward to the next lesson. We will take a closer look at a tool that allows us to peek into the cards of the largest traders in the market. I would even call it an unfair advantage. But it will not be all just theory, as we will assemble all we have learned so far into a real trading strategy. Thank you for your attention and have a great day.